Thanks, James. It's Buerta, by the way. Now that James covered the international situation, let's just talk a little bit about global and local bonds and what that looks like in a zero rate world, and just think through what some of the consequences might be on the economic growth and some other interesting variables that affects investments. So we'll be discussing a little bit around debt levels, economic growth, something called zombie companies, a little bit of a step change in how markets tend to react to these things, where we think rates and inflation are going forward, and just a little bit of discussion about the South African situation and how it affects us. So if we try to understand life as we know it, this is generally the situation. On the screen in yellow, we have South Africa's debt versus GDP and how it's grown effectively from 2009 and how it's forecasted to grow into the rest of this year and early next year. At the same time, we have the real yield, or the real 20-year yield. And what we can see is that that has actually grown pretty significantly over that same period. We can see that in 2013 and 2015, the real 20-year yield was sitting around about 2%. And towards the end of October, start of November, the real yield was sitting around about 9%, right? So this is just the 20-year yield versus the current inflation rate. And as the debt has gotten more, the debt load has gotten heavier, the degree to which we need to pay up above inflation, specifically at the long end of the curve where there's fiscal risk, has increased over time. Now, this makes sense to us. This is intuitively correct. We understand that the more debt we have, the more risky we are, the more we need to pay. That's generally how we understand the world. And if we look a little bit broader, we'll see that, well, it's not just us. That's broadly how the world is structured, right? On this slide, we've got a range of different emerging markets, everything from China and Chile all the way through to Namibia, South Africa, Angola, Mozambique, Gaborone, all the way to Sri Lanka and right there, Argentina and Zambia at the top end. And as we can see, the riskier the credit becomes, the higher the credit spread becomes. Now on this chart, we can also see that some are more expensive and some are ranked as rich and cheap, etc. But broadly, the riskier a country becomes, the more expensive their credit becomes. Now let's just see what this looks like in the rest of the world. On this slide, we have the USA, and once again in yellow, we have its debt to GDP, and the other line is its bond yield. But I purposefully put it around the wrong way because in practice, that's actually what it looks like. In the US, as interest rates, well, as bond and debt to GDP has gotten higher, bond yields have actually dropped. We have actually seen that bond yields have dropped to negative 1%, effectively from about 4% in 2000. Now, this is the real 10-year yield of US inflation-linked bonds. So whereas our real yield in our 20-year space has gone up to about 9%, the real yield on US bonds have actually dropped to about negative 1%. Now, this has started to drift up a little bit slowly, but as of today, the real yield on US 10-year tips is still at about negative 0.9%. So the gap between the real yield that's available is pretty significant between South Africa and the US. And for some reason, that relationship between higher debt and higher rates doesn't actually seem to hold when it comes to the US. So let's see what the situation is like in some other countries. If you look at Japan and Europe, you can see their debt to GDP has risen quite consistently all the way from 2000 to 2020. European Union debt has grown from about 70% to almost 100% debt to GDP. And Japan's grown from 140% to almost 280% debt to GDP over that same period. And yet, if you look at the interest rates or the yields on bonds in those economies, what we see is that over time, we've actually seen a drop in yields. We've seen a drop in yields both in Japan and in the European Union. By the way, if you have any questions for me in the presentation, please ask them on the side. I will try and get to them at the end. So there seems to be this club of countries where, regardless of what happens to the debt to GDP, yields just drop over time. Now, partly, we know why this is the case. On this slide, we can see is the history of the crises the last couple of years, right? We've got 2001, right? We've got the 9/11 bombings. We've got the Great Recession. We've got oil price crises, etc., right? And what we can see, specifically in 2001 and 2008, is that there's a significant amount of time that passes from the top of the cycle, when share prices peak, to the bottom, to when they peak again. In fact, from 2001 to 2006 to 7, it took almost 7 years for that to happen. Once again, in 2008 and 2009, we saw from peak to trough took quite a significant amount of time. And then from trough back to peak took another couple of years. Now, in 2020, peak to trough, back to peak, occurred in less than 6 months. Right? We understand why this might be the case. Reserve Bank and fiscal reaction and intervention has happened a lot faster and to a much greater extent than has happened historically. Policymakers across the globe have been much happier to intervene in their economies, to try and prop up their stock markets and their economies. And it's had definitely effect of ensuring that stock market losses are relatively temporary. It has, however, also had some other effects, right? So let's just firstly look at how this was done. And on the chart to the left-hand side, you'll see, well, firstly, you have the central bank balance sheets of the Bank of Japan, the ECB, and the Federal Reserve. And you can see how that's grown over time with a significant spike now. We know that, for example, in the US, the Fed used to buy mostly, if almost exclusively, government bonds. Recently, it started buying both investment-grade credit and more recently, as even that, some high-yield credit by ETFs. In Japan, they buy bonds, credit, they even buy equity ETFs. Now, this has several different effects. Apart from the fact that it tends to push down yields, it also tends to push people from asset classes where they can make returns. It pushes down the return that you can get on various asset classes. Everything from government bonds to investment-grade credit to even high-yield credit, and in Japan, even equities. Because what is now the case is you have a buyer that does not care about price. And there's an old law in economics. It's actually called Greshams Law. It is that bad money drives out good money. This was actually coined around monetary theory, which is quite interesting given that what they call this new set of implementation is called modern monetary theory. Now, Gresham's law of bad money drives out good money, the original application was when kings and emperors used to take the silver coinage, melt it down, add iron, and effectively devalue it. And you would have a situation where people would be able to judge which coins had more silver and which coins had less silver. And the coins with less silver would drive out of circulation those coins with more silver. To some extent, the same thing is happening in asset markets. Bad money, in other words, money that's not return seeking, is driving out good money. And it's pushing them into other places. Now, for example, what's happening is more and more people are taking equity risk because it's the only place, specifically in the developed markets, where you can really get significantly higher than inflation returns. Increasingly, people are looking for alternatives, like, for example, increasingly they're starting to look at perhaps emerging market assets. Right now, part of what this does is it affects the price-making mechanism of the markets. Right? If you think about one of the central tenets of capitalism, it is that the markets function in such a way to establish the correct price or the correct yield or the correct spread of an asset. Now that you have a gorilla with its thumb on the scale, what that means is that the price or the yield that you're getting when investing in something like investment grade credit or even offshore high yield credit isn't really sufficient to reward you for the risk that you're taking by investing in that asset class. It throws off the risk return balance. It makes that people are taking incorrect risks, or at least inappropriate risks. So what are one of the other effects that happens? Well, since effectively the late 90s and the early 2000s, what we've actually seen is the rise of zombie companies in Japan. Now, we know that Japan has had very low interest rates now for a significant period of time. What this does is it gives rise to these zombie companies, companies that are neither alive nor dead. These companies has an interest expense that is larger than its free cash flow. Now, because of the current situation that we find ourselves in, it is likely that increasingly we will see the rise of these types of companies, not just in Japan, but also in the US. Because not just is interest rates low, your front end rates and your bond rates, because this is being manipulated by the central banks, but also your spreads are low. So whether you're an investment grade company or high yield company, you now have lower interest rates or base rates via central bank manipulation, and you've got lower credit spreads via central bank manipulation. That means that more companies will survive that perhaps should not have. One of the other central tenets in the modern market economy is that companies that don't do well shouldn't survive. The concept is called creative destruction. In much the same way that Apple and the rise of Apple led to the fall of Kodak and caused Canon and many other camera makers problems, in much the same way there are several companies out there that could rise at this point in time. Several of the strongest companies that we know of, some of the largest companies at the moment in the world, effectively really started their upward J curve in 2008, 2009. Facebook is an example. It's these types of companies who can now try and overcome its older, slower, less efficient peers. Now that's a little bit harder because these large companies just keep on surviving. They just don't go bust. They have access to easy and massive pools of credit. If there's a small up and coming peer, they can just buy them. We've started seeing this already. So there's an interesting thing that then happens. So there's a third effect, right? Now, in 2010, 2011, there was a famous study by Reinhardt and Rogoff, and there were some issues with the study that was later found. But during the 10 years after that, there were 24 studies that investigated the similar principle. And that was to investigate the impact of high debt on GDP growth. And of the 24 studies, 22 found that the higher a country's debt becomes, the slower its growth becomes. And that threshold is somewhere between 75% debt to GDP and 100% debt to GDP. And the higher it becomes, the bigger the effect becomes. There's an increasing impact. Every dollar of debt spend has lesser of an effect than the previous dollar of debt spend. Right now, it's possible that the interest rates that are as low as they are might mean that this threshold moves from 75 to 100 to 80 to 90 up to 120. Where exactly it kicks in is not entirely certain, but we do know that it's likely to happen. We do understand historically that high debt affects a country negatively when it comes to GDP growth. And logically, it makes sense. Because once again, debt service costs, even though they are low, starts becoming a problem. But more importantly, you've got inefficient government spend crowding out more efficient private market spend. At the same time, you have large, very unwieldy government departments with significant bureaucracy. So it starts becoming an issue, and these higher debt levels starts affecting GDP growth in these countries. So there's a fourth thing. And as an old friend and colleague used to say, demographics becomes destiny. So if you look at the link between inflation and age dependency and GDP growth and age dependency, the more that a country becomes older, in other words, the more that there is a lower ratio between those that are retired and those that are working. In other words, there are more retirees for fewer people working, the lower inflation starts becoming, and the lower GDP growth starts becoming. And if you look at both the European Union, Europe and Central Asia, North America, other high income countries, you'll see that all of those countries effectively sit in that space. This is also likely to affect lower growth and lower inflation. So what are we likely to see over the next couple of years? Well, firstly, modern monetary theory, the intervention of central banks and the fiscus, is likely to mean that rates are likely to remain very low for very long. We've already heard the Fed committing to very low rates for a while, as well as changing the way they target inflation to average inflation targeting, and is likely to lead to asset mispricing and the misallocation of assets. We also know that zombie companies exist and are likely going to be on the rise. That is also going to mean that there's going to be lower rates, because suddenly government can't afford to let interest rates rise too much. Think about it like this. If your debt service cost is 7% and it rises to 8%, that's not too significant a change in your monthly premiums. If your debt service cost is 1% and it rises to 2%, that is a significant percentage increase to your annual interest rate costs, and can certainly hurt companies and cause a wave of defaults across economies. It's also likely to lead to lower growth, as these larger, less efficient companies don't make way for the smaller, more efficient companies. We are going to see increased debts across the world, right? We know that that's been the reaction from governments all the way from South Africa and Brazil through to the US, the UK, and Europe. We know that these increased debts will require that governments, as far as possible, keep their rates low, and that this will also lead to lower growth. And then lastly, population dynamics across much of the developed world is going to lead to both lower growth and lower inflation. So let's have a look about South Africa. If we look at what's going on in South Africa, this is our inflation view. We expect that inflation is going to average around about 3% for the rest of the year. It might tip a little bit below towards the end of this year or early next year. And then we expect a transitory inflation spike towards the middle of next year, and then inflation likely averages off towards a little bit below 4% at the end of next year. We also expect that surprises to this is likely going to come from the downside. A stronger currency, weaker oil, as well as lower increases or no increases in very big expenses like rent, as well as medical aids, etc. That, combined with somewhat difficult demand environments in Africa, is likely going to lead to a lower inflation forecast. There have been inflation forecasts as extreme as saying it's going to average 2.8% in 2021. Ours is not quite that extreme, but we do expect low inflation, and we do expect another interest rate cut at least in the next 6 months. If we look at the real yield gap, that is the gap between South Africa's 10-year real yield and the US 10-year real yield, we can see that in 2014, that real yield gap was about 1%. As early as the start of 2018, that real yield gap was 1.5%. Currently, that real yield gap sits between 7 to 8%. You are being significantly rewarded for investing in South African debt. Now, we have seen rallies in South African debt markets in the last couple of days post the election. Regardless of that fact, South Africa's debt picture and emerging market debt in general is still offering an attractive alternative to some of what you can see in the rest of the markets. We still expect that foreigners will invest in South Africa, but to be clear, that is mostly a yield play rather than a capital gain play. In other words, we're not expecting our bonds from current levels to see, for example, a 1% rally. We're not expecting our 10-year bond to go from 9% to 8%. But earning 9% or 8% or 7% real yield versus the real yield gap compared to what you can earn in the US is attractive. And it's likely that as the risk environment improves, we will see more and more investors coming towards South Africa. The other thing that's likely also to happen is while we have a benign inflation picture and a benign inflation view, we still think that it's going to drift higher over the next 12 to 24 months. So with the combined strength of inflows and a slightly reduced real yield in South Africa, we expect that real yield gap to narrow, but we expect yields to remain broadly where they are at the moment. So as a conclusion, what are the things that we expect? We expect that rates and inflation is going to be lower for longer everywhere, right? US, Europe, UK, Switzerland, everywhere. Greece's 3-year bond recently just dipped negative. Greece. Now, Greece's credit rating is BB minus, which puts it, depending on who you ask, about on par or even a little bit below South Africa. We expect that rates and inflation in South Africa is going to remain low and lower for longer as well. We are likely going to benefit from the same themes that drive lower inflation and lower rates offshore. We also expect lower growth, GDP growth globally, as that the combination of factors from misallocation of capital to somewhat subdued demographics to high debt metrics come home to roost. And in South Africa, we have all of those same metrics, along with the state that still needs to show the impetus to implement some of the plans and strategies that they have decided on in the last couple of months. These are, for example, renewable energy, spectrum auctions, etc. Now, all of these things can help South Africa with growth spurts and GDP potential growth, but hopefully we will see that come to a head in 2021. Until that happens, though, we have quite a few headwinds keeping South Africa's growth low as well. Please ask me any questions. I'll be available to answer them. And then after that, I would just like to thank and introduce Cornelio Kiwi. Cornelio is our head of credit. I rely on him a lot for all the credit research, and him and his team for all the credit research that goes into all of our portfolios. He's going to talk about Cash Plus has the listed corporate credit market repriced. Thanks for your time again, and I hope you enjoyed the day.